We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodriks. Joining me today is Steve Todoruk. He's a geologist and investment advisor with Sprott Global Resources. How are you today, Steve?
Doing good, Tom. How about yourself?
Excellent. Great to have you back on the show. It's been a while, and I'm looking forward to digging into some of the stuff we have here today. So why don't we start by having you tell us a little bit about your background and what led you to being asked by Rick Rule to move to California?
Well, I guess I was born and raised in Kamloops, British Columbia, and my best friend and me decided to get out of the small town and go to the big city of Vancouver, and signed up for university, and I went into studying geology. And along the way, started working in the bush, mostly up in the Yukon for mining exploration companies, and then graduated and worked in the field for a number of years. Then after about 15 years of being a geologist full-time, I started getting involved in running junior mining exploration companies of my own. I ran two companies for about 12 or 13 years. And then one day, Rick asked me if I'd consider making a bit of a sideways career change, moved down to his office in California near San Diego, to become a stockbroker to help pick gold mining stocks for our clients. I guess he figured that with my mining background, that would give our clients a bit of a leg up in trying to identify the good companies to invest in and staying away from the bad ones. And I've been doing that for about 18 years now, and I love it.
Excellent. So where do you see the most potential in investing in the metal space as you see it?
I'd say resoundingly, the most exciting thing in the mining industry is if a little exploration company makes a brand new discovery and they're then able to drill and grow it into a big, valuable, good quality deposit. You should see that little company taken over by one of the major mining companies, whether it's in the gold space or silver or copper or uranium or diamonds or nickel. So as an investor, what you want to do is get into that discovery plate as early as you can. Ideally, we've got a crystal ball we can rub and it'll tell us what junior and what day they're going to announce that discovery on, but I gave up trying that long ago. So another very good strategy is wait for the discovery announcement. Believe me, in this day and age, if a little company announces a new discovery drill hole, they're going to put it out on, all the electronic means that we have at our fingertips today. And that's when, I can do my quick due diligence and decide, do I like the looks of it? Get in at that point and sit back. It takes, for the most part, close to 2 years of drilling if they're going to defy those horrific odds to, drill off a big deposit. So you've got to, along the way, monitor the drill results and be comfortable with everything. And, stock isn't going to go up all the time, but in general, it should keep climbing higher until they're taken over.
Mm-hmm. So when we're considering these drill results, what types of grades or widths do you want to see, and how do you want to see this story develop over time?
I guess I'll refer mostly to gold and copper, but it applies to other metals as well somewhat. There's two types of mines, big open pit mines and smaller underground mines. So if the discovery drill hole's going to end up being a big open pit, you need to see wide intervals of good grade. For gold, I'd sort of say, to get me excited, I want to see at least 150 meters of 1.5 grams per ton gold. Obviously, I'd love to see 500 meters. I had an Australian junior about 2.5 years ago. Their discovery drill hole was about 250 meters of 5 grams gold. That's fabulous. You tend to drill really big holes in the middle of big deposits. You don't usually drill, or the vast majority of the time, I think you could say, you don't drill big holes in the middle of small deposits, and vice versa. You don't drill big holes in, medium size or little holes. For copper, for open pit, the big ones, I want to see 1,000 meters of about 1% copper equivalent. That can be copper alone or copper plus gold. That's the stuff that the big deposits are made out of, type of thing. For underground, if it's gold, I'd like to see 10 to maybe 20 meters of over 8 grams per ton gold. Obviously wider, but that'll grow a 1 million ounce gold deposit quite easily, type of thing.
And that's really the goal of what you're seeing when you're mentioning those numbers, is you want to see that deposit grow to, let's say, at minimum, 1 million ounce deposit, something like that, when we're talking about gold?
Yeah, for gold, I've always said, as a rule of thumb, you've got to find at least 1 million ounces of good grade gold to justify building a brand new standalone mining operation. To hit that ultimate home run, you want to have a gold deposit that's big enough for Newmont or Barrick. So it's got to be a lot bigger than 1 million ounces. But if a company goes from 0 to 1 million ounces of gold as an investor, you should do okay. You might do quite nice. You're not going to hit a home run, and that's okay. If you're got a basket of, say, 10 of these stocks, you're hoping for one big home run. You're hoping most of them work out, quite good. And full well one of them is going to hit you over the head with like a baseball bat, and you're going to lose a lot of money. That's just the way it works.
So when you're saying home run, Steve, what is that game defined to you as?
At least a 10-bagger. I've got one right now in Western Australia that's a 20-bagger, another one that's a 15-bagger, but at least 10 times your money. That's why you're coming down this far in the speculation and high risk. I want to feel really good that we got a shot at least at a double, in one of these stocks.
Absolutely. So you also mentioned to see, let's say, a copper gold deposit. Do you prefer seeing these polymetallic deposits? And does this remove some risk to you when you're looking at these juniors?
A lot of gold tends to occur in the big copper deposits. It's quite unusual to have copper only. So it's nice to see the mix of copper and gold. I probably prefer more gold than copper in the deposit, but it's fine.
And as I mentioned risk there, how do you think about managing risks when you're investing in juniors? Is it by position sizing or just making sure that you're invested in the right companies?
Absolutely. You always want to be investing in the best companies. That's the best way you can protect your downside. When I say best companies, that means the companies with the best new discoveries, the best deposits, the ones that are looking like they're going to be a mine one day, whether that company, only finds 1 million ounces of gold and there's nobody bigger than them that wants to take them over. Management, changes to more of a mining team. They build the mine themselves and operate it. If that happens, you shouldn't get hurt investing in it. You should make money.
So we've talked before about jurisdictional risk on the show. So what jurisdictions are you comfortable with, and why is this such an important piece to the puzzle?
Well, for one thing, there's a well-known big mining company based in Vancouver that's going through problems down in West Africa where the government wouldn't renew one of their permits. You don't want anything to do with that kind of, event. It's usually not very happy if you're a shareholder. So obviously you want your companies, making their discoveries in as safe a country, as mining friendly as possible. So Australia, Canada, some states in the US, some countries in South America. There's been a number of significant discoveries in Western Australia the last couple of years. And it's like, what's up with Australia? Why are they making such nice, successful discoveries here? It's wonderful because one thing we don't need to worry about is the political risk. And companies that are working, exploring, or mining in higher risk countries always trade at a discount. If their project or their mine was in a safer jurisdiction, investors just don't like risk.
So considering, let's say, the Australian miners, is there any type of consideration that you also put based on the currency that they're going to be operating in?
No. Again, ideally, a junior makes a discovery. Within 2 years, they've drilled it out. It doesn't get any bigger. It's good enough. A major comes in and takes them over right away. We're out of there. That in an ideal world, that happened for me with Aurelian when Kinross took them over a number of years ago. If it goes on past that, now, they've got to start doing different things, metallurgy, permitting and social issues and all that. And that's not what the little company's good for. So what I don't like is for company that's made a new discovery to start talking about operating, building a mine and operating. Totally different skill set than when you're out just drilling holes.
So if that does go ahead, do you want to see some type of a management change to more of a mining, building and operating type management team?
Absolutely. You need to, because like you're talking, going from geology to engineering, vastly different skill sets.
So how does being more of an institutional buyer of juniors change your strategy versus if you were just investing a personal account?
Well, if I get excited and I really like a new discovery and I go into the market to buy, a lot of shares for all my clients, we become a significant shareholder in the company. At that point, we have a serious problem. How do we get out? What's my exit strategy? The exit strategy is if they can successfully grow that big deposit, then get taken over, then we sell into that takeover. no problem at all. I could sell millions of shares, on the announcement of a takeover, because that's what the big companies are for. They want to own 100% of the little one.
And as you're talking about this exit strategy, Steve, do you have any rules around taking profit on the way up, or are you just aiming for that takeout target when a major moves in?
As long as I continue to feel good that the deposit is still wide open and getting bigger, why would I sell? I sort of use the Aurelian story as an example. A lot of people say that when a stock doubles, you should take half your money off the table. Mm-hmm. I got my clients into Aurelian at $3 a share. The stock went from 50 cents to $3 in about 3 days on their discovery hole announcement. So we're in at $3, and within weeks, it was up over $6. Then the deposit, they only drilled their first couple of holes. So I sort of say, if I would have recommended, let's sell half of our Aurelian at $6, and it went on to $34 a share a couple of years later when Kinross took them over, my clients would be questioning my ability. So I don't have a rule of thumb that, we've got to take money out along the way. What will happen is if we get into a stock early and it's doing really good, whether it's up 5 times, 10 times, 15 times, or 20 times, if I get a brand new discovery that's announced and I look at my client's accounts and say, okay, how do I fit the new one in? Well, I got to sell something. So I start, are there any weak sisters in there? If I'm on top of my job, there shouldn't be weak sisters in there. There's almost always is, but I might have a real good win that everybody holds shares in and say, well, let's book a little bit of profit to buy the new one. We still have lots in the initial one, but that's more commonly when I'll book profit.
So, Steve, considering the amount of placements, let's say, that were offered in the last 2 years, are there any more good deals or good stories out there to invest in still? And I ask this to try and get some perspective on where we are in this gold market cycle.
My own opinion in regards to private placements is warrants is that you do not need warrants to make money in this sector. My clients are doing extremely good over the last year and a half. And I think there might be only one stock that we did a private placement and then we got warrants. The rest, it's just we're going in the market, we're buying shares. And like I say, the one where I've alluded to that my clients are sitting on a 15 bagger and a 20 bagger right now, we just bought shares in the market. Nobody's complaining that we didn't get warrants along the way. Mm-hmm. And then, are there any good, attractive private placements out there to do that, theoretically, when you mention private placement, you're thinking that could come along with a warrant. Well, in the kind of market we're in, whether you want to call it a good market or a bull market, the good companies don't need to offer warrants. Guys like me, if there's a new discovery, my first concern is how do I get size? I don't care about the warrant. I just want to get my whatever I want, 3 to 5 million shares. Mm-hmm. So if I can do a private placement and get it all at the same price for my clients and then divvy it up for them, mission accomplished. And that's the way the big funds are as well. There's rarely any warrants in good stories. So if you're getting a warrant today, that's probably a flag. Mm-hmm. Why are they offering it? A warrant is meant to entice the investor to write a check.
So considering, though, that we're seeing more exploration dollars, let's say, flow into the space, does that mean that we're likely in the midpoint of the gold bull cycle? Or how do you see that as, just to give us some perspective?
I don't know. Again, my crystal ball doesn't work. There's a line of reasoning that after the horrific bear market we went through here a couple of years ago, does that mean that the next bull market is going to be one of the longest that we've ever seen? I don't know. I'll let you know when it's over.
Yeah.
Just keep investing in the best stocks. And sitting here today, like you couldn't have painted a better picture for gold than the world we're living in today. So I got to think we've got some legs left on this.
Absolutely. So as we see, let's say, high grades not being discovered as often, and we see just in general grades falling across the board, what does this mean for, let's say, gold and silver prices going forward?
Well, starting from the simple line of reasoning as a geologist, it's getting harder and harder to find new gold deposits. They're getting deeper and deeper. And the only way we're going to find them for the most part in safe countries, especially that are mature for mineral exploration, is to continue refining and developing geophysical equipment that can see deeper. And then, all you're going to get is an anomaly. You don't usually have a high level of confidence when you wind up to drill a geophysical anomaly that there's going to be gold or copper down there. There's only one way to find out. Develop that anomaly as best you can, then wind up and drill a hole into it, see what happens. There's still easy deposits to find in godforsaken countries like the Congo and, other high-risk countries. But, again, as a geologist, don't ask me to go to work in some of those countries.
So Steve, what different considerations do you have to keep in mind when it comes to other classes of deposits? Let's say for copper or silver, any other junior stories that you're looking at?
Well, I think something like, say, metallurgy. You want to be on top of the metallurgy, or you want to have the company, addressing and doing the studies to release to us, the investors, their findings. If they find a big enough deposit, can you mine it economically? Metallurgy is a big part of that. So things like that, you got to dig a little deeper to get that information, because that's very important as well.
And the metallurgy means how they're going to basically go about processing the ore, correct? That's
right. If you've got copper and gold in there, is the gold locked up in other minerals like arsenic, or is it encapsulated? Do they need a roaster? Because if you need a roaster to get the gold out, like the Newmont Barrick have in Nevada, those things cost a lot of money just for the roaster, on top of all the money for the rest of the mining complex. So you've got to know, can you get the gold out? Can you get the silver out? Can you get the copper out in high enough quantities to justify the whole mining exercise?
So if you have some type of metallurgy, let's say that you would need a roaster, is it more attractive to you to have one nearby that they can maybe set up some type of an agreement to use?
Yes, I'd say obviously the problem is that the owner of that big roaster might not want to, do business with somebody else. They might want it all for themselves. Sometime they will. If they're not running the roaster at full capacity, they might be real happy to get a little more in there, because when it's running at full capacity, it's probably running smoother, more efficiently.
Mm-hmm. So, Steve, are there any other, let's say, classes of deposits or different metals that you look at specifically, or is it just something that fits your criteria of being a junior that is hitting that exciting new discovery phase?
Yeah, I don't really have criteria. They're big mining companies mining each of the commodities out there. So they all need, new deposits in their commodity field, if you want. So as long as that new discovery is good, I'm in type of thing. The reality is that most investors in this space want, precious metal, mostly gold exposure. So the message to the juniors is give the investors what they want. We need to go out and get a good gold project. See if we can make a gold discovery. Mm-hmm. So that's why we're going to see most of the discoveries happening in the gold space, then in the copper space. There's a lot more copper and gold deposits around the world than there are silver deposits. That's why there's so few silver mining companies and silver exploration companies.
Mm-hmm. So, Steve, what is a prospect generator, and do they have a place to fit in your portfolio?
Well, I need, let's say there's 1,500 juniors in Canada and 1,500 juniors in Australia. The numbers aren't exact, but, call it. There's a lot of companies out there exploring. I need as many companies out exploring, trying to make that next discovery, to drill that discovery drill hole. I don't care who it is. It can be a prospect generator. We've had a few. Reservoir Minerals was a prospect generator a number of years ago when they made their big copper gold discovery in Europe. That was a fantastic win. I was in on the discovery hole announcement. Prospect generator fans would have been in earlier, because that's the business model they like. If you're not a geologist, you commonly hear a lot of the people or the gurus in this sector, bet on the people that have made discoveries before. So, the prospect generator companies tend to have a track record of making a discovery before. And so let's bet on the horse. Let's see if they'll do it again. We trust them, but that's not my niche. I want to see that discovery drill hole before I bite.
I want to go back to something that you were just saying, that a company wants a gold asset right now. So do you take anything, let's say, do you discount a junior that you could be looking at if they have different types of deposits, or they don't seem to be focused on only one type of asset?
Again, I'm looking for that discovery drill hole. If a company has a number of different projects and they're doing, little bits of work, whether it's dressing up anomalies or drilling a couple holes here, drill a couple holes on another property, I don't care where the discovery drill hole comes from. I don't care who the company is. I really don't care what their track record is. Just show me that discovery drill hole. And then everything changes on a dime. They've got a new life. They've got a new focus. So that tends to sort itself out quite quickly.
Excellent, Steve. Of course, you're available to give comments on different types of portfolios to our audience, kind of like the way that Rick Rule does as well. So tell us a bit about your process of doing that.
Well, I've gone over and looked at over 1,000 investors' stock portfolios that Rick has passed on to me over the last, I don't know, year and a half, I guess now. And, I like to think I'm a pretty knowledgeable person in this space. So if clients or investors have, good stocks on there, I can give them a pretty good detailed comment. I can pretty well talk your ear off on any of the top successful companies in your, and those would tend to be the companies that have made the good looking new discoveries. You got a big ladder that goes a long way down, and you don't want to be investing in companies that have lousy projects or lousy management. That's the bad part of the pool to be swimming in. So, the most common comment I make is, I don't know your company. That's not a good thing coming from a guy like me. If that investor thinks they're investing in a good company, I got news for you. You better be praying really hard.
And that's simply due to the fact that that's your job to basically research this stuff, right?
Yeah, well, you research it. I'm able, as a geologist, I'm able to interpret the results, the drill results, the geophysical results. By no means am I the best geologist out there. I probably know just enough to be dangerous type of thing, but, I'm pretty comfortable with that.
Excellent, Steve. Is there anything else you'd like to add as we wrap up here?
Try and be swimming in the good part of the pool. Get some help. That common saying, you get what you pay for. And this is a highly speculative sector. If you're in a bull market, it's like shooting fish in a barrel. Everybody wins. You can throw a dart as long as the company's got gold in the name, the stock's probably going up. But I always like to say you should always be invested in the best companies in anything. Just makes sense.
Absolutely. Steve, can you give us an idea of how you're saying that ladder really extends a long ways down on these junior companies? So how many positions are you looking at this time?
I've probably got about 10 or 12 companies that all have nice to really good looking discoveries. That's a nice list. If you're going to get a really big winner, you want to have good exposure to it, so it's a meaningful win for you. Mm-hmm. So I don't want to see 25 to 50 stocks in a portfolio that just, you got small positions in way too many names. There's no way there's 50 really good companies in this space.
That's a great point, Steve. What's the best way for our listeners to get a hold of you if they want to have their portfolio reviewed?
Send me a note to my email address. It's stodoruk@sprottglobal.com.
Excellent, Steve. And I really want to thank you for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.